All right, guys, let's kick it off here. Where people are anxiously awaiting to hear from you two, and with good reason. To brag on you a little bit, you two are amazing. Over the last couple of years, we've turned to you for information, for advice, for counsel, and during that time, we've looked. Larry, you turned to the rolling recessions by sector that we've gone through. Seems like there's hardly any sectors left there now. That's been you've walked us through the cost of capital and what it would be, what it likely would be, which is of huge consequence. Larry, you walked us through the unprecedented increase in funds rates and what impacts that would likely have. So you've helped us in so many ways to run our businesses, to understand what was happening in the marketplace. You walked us through the impact of COVID, and here now we're actually looking at COVID probably in the rearview mirror for as far as we can see. You also took us through the shocks in the labor market, the impact on banking. Bob, you've been so impactful there in teaching us and guiding us to what would likely happen in the banking sectors. And now you've taught me that when you say banking, you mean the regionals, the super regional money center banks. You talked us through the regionals, and now the whole emergence of private credit. And my understanding now is that private credit is a much bigger marketplace than I realized. But you were talking about how private credit was starting to encroach on the money center banks' activities, but that seems to have abated in the last quarter. So, Bob, let's start there, because everything about our markets today, our economy, our ability to manage our own businesses is all about capital, access to capital, cost of capital. What would you tell us now is the state of access to capital? Because we have the Treasury at, let's call it 4.5%, which is a huge increase in the last 18 months. But capital doesn't seem to be constrained in too many places. The only place I can think of is perhaps in the startup community, the real venture community. Things have tightened up quite a bit there, but not inappropriately. So what's the state of the play with capital, access and cost, and where's it coming from, Bob?
It's a very, very interesting question, Jimmy, and I think it goes right to the heart of why in Atlas Merchant Capital today, our number one priority is a strategy to get our LPs together investing in regional and community banks. We forget sometimes here what an incredible economy we have and what an incredible financial services industry we have in the U.S. There are reasons that the U.S. economy is still strong, and the rest of the world is looking at us and saying, how did this happen?
Yes.
You took rates from 0 to 5.5% over a very short period of time. Every smart person was calling for recession. Everyone was calling for a weaker economy. And here we are. I mean, both Larry and I have been saying for a while, watch the economy, because the reason we have felt that the rate cuts were not coming as quickly as the market is because the economy was recovering well. Not even recovering, it was remaining strong. Larry will talk about that. One of the reasons is the depth and breadth of the financial services industry in this country. And one of the core tenets of that is 4,500 banks. And
those are the regionals, right?
The regional communities, no other country in the world has a banking system such as the US. And the service they provide in providing capital to small and medium enterprise businesses, to family offices, to startup companies, to venture companies is incredible. And the valuations are down. So we think that there is a real need. You know, it might not be 4,500, maybe it's 2,000, 2,500, or 3,000. There could be a period of some consolidation, but we think investing in the winners and helping them acquire some of the weaker players is a strategy that will be beneficial for the U.S. and the financial system, but very, very beneficial for our investors. And I think we should not underestimate the depth and breadth of our financial services industry in the U.S. It's why David and I started Atlas Merchant Capital. How do we invest in financial services outside of the big money center banks in a way that's good for our investors, but also really, really good for the development of the financial services industry in the U.S. and other developed economies?
When you talk about no other country, no other economy, in that you've been an international banker. You ran Barclays globally, which had big operations in Asia, in Europe, obviously, North America, and in Africa, South America to some extent. So you've had the seat where you've seen those different economies. You've seen where the impact of not having those regional banks, those other banking institutions have a consequence in terms of business formation, capital formation. But when you talk about the 4,500 regional banks here that you say are the lifeblood of our economy, because you can't just rely on the super money center banks like some other parts of the world have to, then that begs the question, is your strategy now really just taking advantage of an unusual shock that hit the regional banks with that 5.5% change in the Fed funds rate that sent a shockwave through those regionals? You say there's a lot of good banks, really well-run banks that had this shock. That seems to me like you're just being opportunistic and doubling down, bringing capital to a market that needs it, and that will be properly rewarded, in your opinion.
I think it's a little bit of both. Certainly, there's the opportunity in that valuations for those banks, we believe, has gone too far. It's too low. It's a function of every single deposit-taking institution had a loss in their treasury portfolio. When rates go from 0 to 5.25, that happens. That's manageable. We can see that. We can adjust for that. I think the regional and community banks had a higher percentage of loans to assets and a higher percentage of commercial real estate to loans, but that's also manageable. Many of these institutions were very thoughtful with their exposure. Much of it was local, in Des Moines, downtown, not in New York City or LA. Mm-hmm. So the purpose of Atlas Merchant Capital is we can find the winners who are suffering from this. And then the big thing is that the reaction of the regulators and the Fed to the failure of SVB and Republic Bank, particularly the San Francisco Fed and the New York Fed, is very intrusive right now. So the smaller community banks that had good 10 to 15% consistent returns with higher regulatory intrusion around technology and KYC, it's going to hit the cost income ratio. And many of these are very, very solid, good banks, but some consolidation is going to happen with that higher cost base. So some of this is being driven by the environment and the regulators, some of it by lower valuations, but I will assure you, in these 4,500 banks, what we're looking for in Atlas Merchant Capital is 5 to 10, 25 to $50 billion real winners, real strong platforms that would welcome an investment from Atlas Merchant Capital and our investors, where we can help drive both organic growth and strategic opportunities. And I think in this space, very few people are willing to operate with this intrusive regulatory environment. For David and I, this is what we've done our whole careers. So operating in a highly, highly regulated environment, whether it was acquiring Lehman during Lehman weekend or David's activity in acquiring IndyMac, we've been through these environments and we are welcomed by the regulators. And I think many people just don't have the experience and move away from this investing opportunity because of that regulatory intrusion.
Interesting. And Larry, you and Bob on our first broadcast at the very beginning of this calendar year said, no, calm down on the Fed rate cuts. You said the economy was strong, inflation. You've always told us, Larry, that inflation is important, but not as important as it might prima facie seem. What was most important, you told us, is the steadiness, the predictability of that inflation number. Well, we have new CPI data that came out. And as I've learned from the two of you, we look at the real estate, and it's not just commercial office real estate, it's industrial. We have a whole big demographic change that's hitting our economy with real consequences on the cost of capital. We have a re-domestication of so many of our industries, which is going to suck up a great deal of capital and cause some boom times. So Larry, you were right that there'd be nothing. You and Bob said, don't expect a rate hike in the first half of the year. What's going on with the economy, Larry, and what are you expecting from our friends at the Fed?
Yeah, so thanks, Jim and Bob. I always think if you're going to try to figure out where we're going, it's really useful to know how we got here, what's going on now. That's step one. And I'm actually going to start with a little more than a year ago when SVB Bank failed. just a little more than a year ago, and depositors were yanking their money out of the small and regional banks. I mean, the Fed had raised rates from 0 to over 4.5% in the space of just a year, and it looked like things were starting to crack. We all know the regulator stemmed the crisis by guaranteeing deposits. The Fed established a bank lending facility, but then it went ahead and raised rates by another 75 basis points in the next few months. And as you just said, everybody was forecasting a recession. What occurred is
not you, Larry. Not you, Larry.
Right. Well, what occurred was exactly the opposite. The U.S. economy actually, right around then, may sound strange, began an acceleration that continues to this day. And even though the economy surged, inflation made it an impressive move down, all the way to the Fed's target of 2% in the second half of last year. Unfortunately, at least in our view, that decline seems over. And just as you alluded to, Jim, if you look at inflation in the first 3 months of the year, the core inflation, which is what the Fed looks at, excluding food and energy, which is considered where the trend is, ran over an annual rate of 4% in the first quarter. You look at the stock market, obviously, as it's sinking in that rates aren't going down anytime soon, it's taken a little bit of a setback, but it's been very strong, reflecting the strength in the economy and the solid rebound in corporate profits. And when you add all this up, this does not look like an environment where the Fed begins a rate cutting cycle. And I go so far to say, as we think it would be irresponsible to start cutting rates now, because it would probably create a bubble that would set the stage for the next recession.
That's a headline, Larry. If you think it would be irresponsible, that changes the flavor of your predictions here quite a bit.
Yes. And I'm talking about in the next 6 months or so. I mean, so let me go through why, what's behind all that. And you look at the data, you again go back. The economy hardly grew in 2022. If you look at GDP, it rose 0.65%. After the Fed embarked on its most aggressive monetary tightening since the Volcker years. And of course, the interest rate cyclical sectors, housing and manufacturing, do what they always do when the Fed hikes rates aggressively, and they got killed.
And Larry and Jimmy, let me interject one thing before you go through this, because I would just ask our listeners to put yourself back in January and February, when the consensus was 6 rate cuts starting in March, probably 3 before June. This is the consensus. And Larry and I both said at the time, thanks to Larry, what would happen if the economy rebounded? The Fed's not going to take that risk. Where would we be today if they had done 1 or 2 cuts and we saw these numbers right now?
Where would we be?
In a pickle. The Fed would be in a real pickle. Larry, go ahead.
That's right. That's right. Anyway, as I was saying, usually when these cyclical sectors go down, these are how recessions start, because they cut jobs. That goes, reduces income and spending, and it starts to infect other sectors. But COVID created a huge shortage of workers, and we had massive fiscal stimulus that created lots of wealth and excess savings. And so consumers continued to spend,
and inflation,
businesses
right?
continued to hire. Right. That's right. So instead of going into recession, the economy actually rebounded. So after barely growing in 2022, it grew last year in the first half, like 2.2%. In the second half, it actually grew over 4%, which we hadn't seen in many years. So instead of a recession, we actually got an acceleration. Now, when we look at the first quarter, we just completed the first quarter of this year. I mean, things like inventories and trade can swing quarterly GDP one way or another. What I like to look at, it's something called, final sales to private domestic purchasers. What's that? That's basically consumer spending plus business spending. That really drives the economy. That's been increasing at a rate of over 3% since the middle of last year. That we haven't seen that kind of strength in a long time. Now, if you look at estimates,
Is that
of
inflation adjusted, Larry?
yeah, inflation adjusted in real terms over 3%.
Wow.
So now people are thinking 2 to 2.5% GDP for this first quarter, but that's because they're expecting a drag from inventories. Believe it or not, that's actually a positive sign because what it reflects is that the demand for goods has been exceeding production. So that's why the inventories are going. That's actually a positive forward sign.
Which is a big
And
swing from last year, Larry, when we were suffering with supply chain issues. So everyone who had the balance sheet strength to do so, inventoried up so that it wouldn't be caught short. And now you have the undoing of that cycle this year.
exactly right. That's why the goods economy and manufacturing got so weak. And then you look at the labor market. We just got, you remember last week, the March employment report, which showed a job increase of over 300,000. That was about 50% higher than most estimates. You look at the last 4 months, job growth has averaged 280,000 a month. The 4 months before that, 200,000.
And what about participation rate? That's something you always point out to us.
Labor force, yeah. But there's something I haven't mentioned before. You can actually get an estimate of what's going on in income from the employment report if you multiply jobs by hours worked by wages. That's basically a proxy for income. It grew over 6% at an annual rate in the first quarter. So what this means is there's plenty of fuel in the tank for consumer spending going forward.
So that goes
And
to
what's
Bob's point of
interesting-
capital is available. And
Yeah.
and a 5%, let's call it a 5% cost here, isn't too bad. It's historically cheaper than it was.
That's a very good point, Jim. You know, how restrictive is Fed policy? But let me take you through this. Because one of the interesting things is you would think if employment's growing so fast,
Yeah.
wage growth has to be going up. The employment rate should be going down. Neither of those happened. Okay. So you look at wage growth, it was 6% a couple of years ago. The latest numbers show it's now running 4%. The unemployment rate's actually edged up a bit. Why is that? It's just what you said, Jim. The labor force has been growing impressively despite a low birth rate and the aging of the population. What's the
That
answer?
raises a big question there, Larry.
Yeah. What's the
Who's
answer?
filling those
This may
jobs?
shock you. Well, maybe it doesn't. It's immigration. It turns out that's what all the studies show. It's this surge in immigration. Now, part of this is just we had like zero immigration for a couple of years because of COVID, but it's surging, and that's increasing the labor force and allowing all this job growth to occur without putting upward pressure on wages and decreasing the unemployment rate, which is still under 4%. It's fine.
But Larry, as I look out the window here,
Yeah.
in Midtown Manhattan, and I see the Roosevelt Hotel and a lot of immigrants who are undocumented or waiting their status change, however they're best defined, they're not working. They're not allowed to work. So which immigrants are filling those jobs? Because those of us who live in areas where the immigrant population is coming to in large numbers see the social consequences of that, the criminal consequences of that, and yet they're not working. So who are these immigrants?
Yeah. So first of all, by the way, I don't know if you look at these statistics, it turns out a natural born American citizen is more likely to commit a crime than an immigrant, actually. But anyway.
All right, let's go for a walk down 44th
places.
Street, you and I later.
Yeah, right. No, they're going to the wrong places. That's part of it. There are a lot of states, there's about 12 or 13 states that have net immigration, more people leaving than coming in. And they need how many people you know that can't get enough workers? You know, you go to a restaurant, it takes forever to get and so a lot of these people, Jim, and we know the farming story, you know, picking and fruit or whatever it is, but also in places like restaurants, bagging groceries, and a lot of these people, the illegal ones you have to be here 6 months to get a job. Sounds a little crazy. We'd like these people to work, but unfortunately, you have to, even if you're legal, it takes 6 months to be able to get a job permit. But a lot of them are getting paid under the table. But let me get to because it's not just the labor market. There's a bunch, when you say like the Fed raised rates 550 basis points, we've always go into recession. How's this economy stay so strong? So let me just list a few things. One, the drag from higher rates is fading, actually. So when you look at studies of how does Fed policy affect the economy, it's not just the level of rates, it's the change.
Yes.
And the Fed hasn't raised rates in more than 8 months. As you noted, these sectors that are cyclically sensitive, housing and manufacturing, they've gone through their recession and they've actually bottomed. I just noticed existing home sales, which have been held back by a dearth of inventory because homeowners don't want to part with their low mortgage rates. They're up 13% in the first 2 months of the year. And if you look at new home sales, they went up like 34% from mid-2022 to 23, and they've been hanging at very high levels. Manufacturing activity has been weak, but there's a lot of signs that it's moving up. We just got the purchasing managers survey for manufacturing for March. It was the first time over 50. That means things are expanding in 16 months. If you look at the production component, that went up 6 points. This reflects to the fact of the drag from lower inventories. Financial conditions. Usually when the Fed rates are up here, financial conditions are not doing well. What am I talking about? Things like stock prices, bond yields, the dollar, house prices. The financial conditions index, the Fed puts it out. It got a lot tighter for a while. It's back to where it was before the Fed started hiking rates. Corporate profits. You would think with high policy rates and inflation actually coming down, because that inflation is usually good for corporate profits, at least in the short run. Profit margins are close to record highs. The other thing is businesses are benefiting from this improvement in the supply side, coming not only from a rising labor force, but also strong productivity growth. And then, as we said before, this rapid growth in employment is creating income gains. Household wealth has increased nearly 12.5 trillion since the third quarter of 2022, mostly from stocks and house prices. So the bottom line is we're seeing strong gains in business profits and household income and wealth, and that means spending in both sectors is going to remain brisk. And let me say one other thing, Jim, because at the beginning you were mentioning how there's a lot of home sourcing and building going on. And we all know about office vacancies due to remote work. Malls aren't doing so well. It turns out construction spending in real terms has been increasing by about 10% per quarter for 3 quarters.
Wow.
What's interesting is residential investment fell 25% during 2022. It's now growing. Non-residential construction, even though, as Bob says, there's exposure to commercial real estate, there's a lot of other semiconductors, clean energy, all this stuff, some of it's subsidized. That fell for 10 consecutive quarters, non-residential construction. That's growing. And public construction is growing, like schools and those kinds of things and bridges. Let me get to inflation, because we can't discuss the Fed without inflation. I haven't talked about that. Again, it fell really impressively. And, core PCE inflation, which was what the Fed looks at, was about 5.5% in early 2022. The year on year is now 2.75%. So that's a big drop. And as I said, in the second half of last year, it actually ran at the Fed's target of 2%. But the story really is looking what's happening in recent months. Inflation so far this year, if you just we just got the CPI numbers for March, and every month has been higher than expected. If you look at these core measures, we don't have the PCE yet for March, but so far, believe it or not, core inflation is running 4 to 5% at an annual rate in the first 3 months of this year. So it's way above the Fed's target. Now, a lot of, you've heard Powell, well, it's not a straight line, it's temporary. But if you look at the details, this whole swing of soaring inflation and then coming down, all the action's been in goods prices. And think about it. What happened? Well, when everybody was stuck at home, They weren't traveling. They weren't going out to restaurants. What were they doing? They were buying a lot of goods online, a lot of it, Peloton bikes, home office furniture, electronics, TVs, everything to make home life better. A lot of people were looking for more space at exactly the same time that we had these supply bottlenecks. So prices went out of sight. You remember used cars. And then when things returned to normal, prices came back down. And,
so Larry, that begs a question. And this is a pet issue of mine. And I spent last week traveling around the country, visiting with different of our facilities at the flowers companies. And what I came away with is a sense of something that I ask you and Bob about each time we get together. And that is, I'm getting more and more the sense that there's two population groups out there. Those that have a home and have a career and have already well established themselves, but it seems to me like there's a moat growing, and that half of the country that is paycheck to paycheck, can't get their hands on $400 in an emergency, that they've felt a 19% inflation rate in the last 2-3 years just on food, fuel, and cost of housing. And those people seem to be feeling it and hurting and expressing it more. And those of us who are older and have already got a house is feeling wealthy because we see the inflation value in our homes. We see that inflation in our wages that you talk about. But the entry-level people, the mouth-to-mouth, the week-to-week, the paycheck-to-paycheck folks, they seem to be hurting. I see a bifurcation, and it concerns me socially and politically.
It's a big political issue, and I'm not a political expert. But what I'll say is this. Number one, what I'm getting to is this big up and down in inflation had a lot more to do with COVID than it had to do with fiscal or monetary policy, although that contributed.
But tell us, what was the number? How many trillions did we spend on stimulus?
Over 5. But it actually pushed, we would have gone in recession probably if it didn't happen. But anyway, here's the thing. As people in financial markets and economists, we focus on the rate of change in prices because once it gets down to where it is now, 3%, 4%, it's not as big of a problem. The thing is that what the average person cares about is the level of prices. And if you look at total inflation, it was running 9% at one time. So the prices we have now, even though the rate of change has come down, the price levels are still high, and that's what people are feeling. As far as this divide, first of all, unfortunately, that's a fiscal policy issue. Monetary policy, they don't have really the ability to help one sector or another. They're basically setting interest rates. But let me say this. During COVID, if you looked at income inequality, it shrunk a massive amount. And that was because of extra unemployment insurance, stimulus checks, the child tax credit, literally child poverty, which is a big thing because you don't choose where you get to be born, fell by half. They did not, and a lot of that was the child tax credit, which actually is a very cheap thing. When you look at
the
that
lack
5
of
trillion,
immigration influence,
and they allowed it to expire. So that's a problem. But the truth is, there's actually less income inequality now than there was before, even though it's still a very big issue. But again, from a political point of view, people care about what's it cost me to buy eggs? Yes. What's it cost me to buy? They don't care when you say, well, inflation there went up 20%, and now it's only rising 2% or whatever.
Yeah, but that's on top of the 20.
Right, exactly. So that's a problem. But let me just continue because I'm almost done here. If you look at inflation, it turns out, even though all the action's been in goods prices, services accounts for about 60% of the inflation indices. What's that been doing? That's rising at something like a 5% rate. So the way we got to this 2% is goods prices actually falling, deflation, and services chugging along at 4 to 5. Unfortunately, there's no evidence that that's coming down, and now goods prices are no longer declining. In fact, not only is the decline in goods prices over, they're actually picking up a little bit. You look at
except for cocoa, Larry. The cost of cocoa is up 130% year over year.
Look, right. I'm saying it's not going down anymore. Yeah. And in fact, they're starting to go up. I mean, first of all, as I said, manufacturing's bottom. When manufacturing's getting crushed, that's when goods prices are going down. If you look at oil, you look at industrial metals like copper, which is a really good leading indicator of manufacturing. That's beginning to pick up, and it's because of demand, increased demand. I like to look at, I don't want to get wonky here, but intermediate prices.
Too late, Larry.
Yeah. Intermediate prices in the producer price index. What's that? These are what producers are paying, and intermediate are prices in the process of production. Those were a great leading indicator of inflation going down. Those prices they bottomed at the end of last year and are starting to go up. Shipping costs, as we all know, have gone up. I don't want to get into that. But if you take all this into account, inflation over the next several months is going to look like a trend of more like 3 to 4%, maybe a little over 4, not the 2%. And that's going to keep the Fed on the sidelines, at least for the next 6 months, barring some negative exogenous event. And if you take this inflation that we're getting, you take job growth, which is accelerated, that's already pared back expectations of Fed rate cuts. We still have people predicting 50 to 75 by the end of the year. There's no June rate cut priced in, but July there's still like a 40% chance or something. And
you're saying that's nuts. Don't expect any rate cuts for 6 months.
Maybe by the end of the year you get some slowing and get one cut, but you're not going to get it.
But then you've told us in the past that the Fed wants to be apolitical, and why would they do something near an election? So you're saying not likely this year.
Right. And I think that's why they wanted to get a rate cut in early, so as not to look political. But they've been knocked out by the data. But let me get to one thing that we started at the beginning, and then I'll end it. But it's widely believed that a rate of 5.5 to 5.25 is restrictive. You look at this, what's happened in the economy last year, which has done nothing but accelerate, and you got to start questioning: is it really restrictive? I mean, the increase in the labor force and productivity suggests trend growth right now is 3% or better, not 2% that we saw in post-financial crisis. You look at inflation, remember, after the financial crisis, we were having trouble getting to 2%. We're in a 3 to 4%, I think, range. I don't, it's not widely accepted.
But for the rest of this year, at least.
Yeah, so the current 5.5 to 5.75% policy rate may not be as restrictive as you think. And Bob and I have mentioned this a bunch of times. Look at what the average Fed funds rate was post-financial crisis. It was 1% or less. Before that, it was over 4%. And let me ask you, does this feel like a post-financial crisis world we're in?
No, absolutely not.
It doesn't. So I think most of the people in the markets, remember, the financial crisis was a long time ago, 2008. They haven't seen that. And I think that's part of the reason why there's this resistance. We're in a different world here today. This is not post-financial crisis world, a world where rates are typically higher, not lower.
So Bob, Larry, how do we think about what you're saying is we're in a Larry David economy. Things are pretty good. And if that's the case, how do we factor in the risk of the big macro issues that we face? That's my last question, because you've told us nothing's going to happen this year. The economy's growing pretty good. We're going to suffer 3 to 4, maybe even a little more than 4% inflation. You think the Fed's not going to do anything because cutting rates in this environment, you said, Larry, would be irresponsible. So with all that in mind, we have war in Europe, ground war in Europe. We have trouble in the Middle East. We have Iran's proxies around the Middle East causing trouble all over the place. How do we, as citizens, as heads of households, as business people, how do we look at those macro issues and say, while we're in a Larry David or a Larry Kantor environment, how do we risk manage those bigger macro issues?
Yeah, and what I'd say is you really can't price geopolitical risk. At least I can't. I think it's greater than it's been in a long time. As I said, we've got 2 wars going on. When's the last time we had a war in Europe? And it's, we can all cite some bad things that can happen. Iran is building nuclear capability. Israel's at war with them. I mean, and I don't know how to price that, except that the risks are high there. What I'm saying is, if you look at the environment, I don't see a change in Fed policy for the foreseeable future. It's amazing how well, corporate margins, this is profits divided by revenue. So profit per revenue is near record highs. I mean, so things look very good. Everybody's talking about the stock market. I know it took a hit yesterday as people, it's sinking in that we're not going to get this cut in rates. But remember,
the market
right
should have
now,
known that because you said that in early January. Aren't they
Right.
listening, Larry?
Yeah, but the major indices aren't even 10% above where they were in December of 2021. And we didn't get the recession that everybody expected. So the stock, to me, if anything's a little off, it's bond yields. Now they're up now to 4.5%, the 10-year. But boy, if the economy's 3% or better, inflation's 3% or better, it's not that high of a rate. When the
Right.
Fed's sitting there
What's the
at
real rate?
5.75%, and you're getting, do I want to buy a 10-year treasury for 4.5%? I don't think so. So I think parking your money in very short term and keeping money in the stock market, I think, is the way to go. But
Well,
again, I don't know how to price the geopolitical risk. Bob is a better person to ask on that. So,
Bob, any last thoughts on how we look at the macro picture? You and Larry have laid out what we should expect this year for the rest of this year, and that looks pretty good. Anything else we should be concerned about, or do we just basically hope and pray on the macro front?
I think, to Larry's point, there is greater geopolitical risk than we've seen in a while. I think in our country, in the US, whichever of the parties wins the election, they would both like to see rate cuts. So if politics comes into this, it's going against what should be higher for longer, which is what we've been preaching. I think the risk, if you're managing a portfolio, is that inflation is a little bit higher than people think. And so higher, longer, there is some risk of higher rates. They are going to be data dependent at the end of the day. I can't factor in the politics, but if the politics did rear their ugly head, as one would say, they would probably be more in favor of higher, longer, more inflation. That's where we stand, Jimmy.
Well, thanks for the summary, guys. Once again, I'll start with what I started. I'll stop with what I started with. You guys are amazing. Thanks for all the help you give us, the insights you give us. There's so much to digest, and you come away with very succinct, thoughtful prognostications for us to deal with in the next 6 to 9 months. Thanks very much, guys.
Thank you, Jimmy. Thanks for it.